Boom, picture this, your alarm blares, you stumble to your phone, and your life savings vanished, poof. Eviction notice slamming on the door, pink slip burning a hole in your pocket, and outside, the world on fire, markets screaming, empires toppling like dominoes in a hurricane. This wasn't a fever dream or some zombie apocalypse flick. No, this was 2008, the financial Armageddon that vaporized $8 trillion overnight, enough to buy every house on Earth twice over. Buckle up, thrill seekers, because today we're blasting through the wildest economic roller coaster ever, from champagne-soaked highs of get-rich-quick madness to the gut-wrenching freefall of total collapse. Wall Street's dirty secrets exposed, the heroes and villains unmasked. If your heart's pounding already, smash like, subscribe for more adrenaline-fueled history bombs, and let's dive into the abyss. Flashback to the early 2000s, America's on fire with feverish ambition. Skyscrapers gleam like golden idols under a relentless sun. Suburbia explodes with McMansions sprouting like weeds on steroids, their vinyl siding whispering promises of the American dream. But zoom in closer. Behind those picket fences, families like Julia's in Melbourne, Florida. A 43-year-old web designer juggling 2 kids and a thriving $270,000 a year business. Feel the pull. One more house, she thinks in 2006, pressured by neighbors flipping properties like hotcakes. She qualifies for a mansion but grabs a modest starter home at the peak, dreaming of maternity leave bliss. Little does she know, this safe bet is the first domino in her personal apocalypse. Banks, they're the slick villains in tailored suits, whispering sweet nothings in boardrooms and living rooms alike. Subprime loans for everyone, no job, no problem, zero down, sign here. These weren't loans, they were ticking grenades disguised as golden tickets, adjustable rate mortgages with teaser rates that lured you in low. Then bam, they skyrocketed, trapping families in debt dungeons deeper than the Mariana Trench. Why the frenzy? Because home prices were on a rocket ride. Up 80% from 2000 to 2006. A housing bubble so massive it could swallow cities whole, peaking at a U.S. homeownership rate of 69.2% in 2004. Flippers flipped houses like pancakes at a county fair. Investors drooled over endless profits, turning sleepy suburbs into speculative casinos. But who lit the fuse? Let's rewind further to the shadowy enablers who built this house of cards. It starts in 1992 when Congress strong-arms Fannie Mae and Freddie Mac, the mortgage giants backing half of America's homes, into funneling loans to affordable housing. Noble? Sure. But it unleashes a torrent of subprime securitization, pooling risky debts into mortgage-backed securities, MBS, sold to suckers worldwide like fool's gold. Fast forward to 1995, 1999. Tweaks to the Community Reinvestment Act let lenders buy subprime junk to check affordable boxes, while Fannie eases credit for the credit-challenged. By November 1999, President Clinton signs off on gutting Glass-Steagall, the 1933 law that kept casinos away from grandma's savings, allowing banks to mingle with insurers and brokers like wolves in a sheep pen. Credit Default Swaps (CDS). Born in 1994 via J.P. Morgan, these insurance derivatives explode unregulated, a $60 trillion time bomb by 2007. Enter the Fed's mad scientist, Alan Greenspan, post.com bust and 9/11 terror. He slashes rates from 6.5% in May 2000 to a whisper-thin 1% by June 2003, 11 cuts in all, creating an easy credit orgy that drowns the nation in borrowing. Irrational exuberance, he coined it in 1996 but ignored his own warning. Wall Street feasts. In April 2004, the SEC loosens net capital rules, letting titans like Bear Stearns and Lehman leverage up to 30 times, betting $30 on every $1, a high-wire act without a net. Subprime lenders like New Century Financial pump out $60 billion in dodgy loans in 2006 alone, while rating agencies, Moody's, S&P, slap AAA stamps on toxic sludge, blinded by fees. The real black magic? Banks don't hoard the poison, they alchemize it, bundling junk loans into MBS and collateralized debt obligations (CDOs), slicing them up like a Vegas dealer shuffling souls, slapping on fake safe labels, and hawking them to pension funds in Tokyo, sheiks in Dubai, even your grandma's retirement account. Countrywide's Angelo Mazzillo. The Teflon tycoon, raking billions, later fined $67.5 million for fraud but dodging jail like a ghost. Globally, it's a feeding frenzy. European banks like UBS swallow $3.4 billion in subprime losses by October 2007, while Asian exporters gear up for the U.S. consumer splurge. By 2005, it's a nonstop rave on steroids. Homeowners like Julia high on home equity lines, bankers drowning in seven-figure bonuses. Wall Street's total haul hits $39 billion that year, wolves howling at the moon with crystal flutes bubbling over champagne waterfalls. Kaori Shigeya, a vice president at Lehman Brothers in London, embodies the high life. 9 years in the city, 6-figure salary, identity fused with the finance machine. We were invincible, she recalls, grinding her teeth in the dead of night from the stress she ignored. But wait, asterisk crack asterisk, hear that faint fracture. February 2007, the housing bubble bursts like a piñata full of shattered dreams. U.S. home sales plummet, the largest single-year drop in 2 decades, and over 25 subprime lenders declare bankruptcy by March. The Dow tanks 416 points on February 27, its worst day since 9/11. New Century Financial subprime's kingpin files Chapter 11 in April, laying off thousands in a bloodbath of pink slips. Julia's clients start ghosting her web design gigs as the real estate hangover hits. Is this the hangover, or the apocalypse knocking? Hold on tight, the tremors are just warming up. TikTok, the clock's racing now. April 2007, subprime bankruptcies proliferate like rats fleeing a sinking ship. New Century's collapse sends ripples Bear Stearns, that grizzled hedge fund operator since 1923, watches 2 of its funds evaporate nearly all value by June, halting redemptions in a desperate scramble. Investors claw for cash, but the vaults are sealed. The fuse ignites for real on August 9, 2007. French powerhouse BNP Paribas slams the brakes, freezing 3 hedge funds worth billions, howling about a black hole in U.S. mortgages that makes assets unpriceable. Shockwaves hit trading floors like a seismic wave. Banks eye each other like cornered wolves in a fog-shrouded alley, whispering, "Who's hiding the bad debt?" Lending, dead, frozen solid as Arctic ice. The credit crunch claws in, strangling the global bloodstream. Interbank markets, the oil of finance, grind to a terrified halt. Cut to chaos across the pond. Asterisk September 2007, Britain's Northern Rock buckles like a house of cards in a gale. The bank, bloated on subprime scraps, eggs the Bank of England for emergency aid, sparking the first mayor bank run since 1866. Depositors swarm branches in a frenzy, miles of desperate faces under drizzling gray skis, pensioners clutching life savings, young couples with mortgages on the line. "Give us our money," they chant as TV cameras capture the panic like a scene from a dystopian thriller. The UK government nationalizes it in February 2008, but trust, shattered like a dropped heirloom vase. Nick Bailey, head of regulation at the London Stock Exchange, fields a frantic conference call on September 14. Lehman's going down, Barclays deal's dead. Stunned silence from 30 institutions, he downplays the unthinkable to calm nerves, but inside, absolute Armageddon. January 24, 2008. Enter the Fed's frantic surgeon Ben Bernanke slashes interest rates by whopping *0.75% to 3.5%. The biggest emergency chop in 25 years a desperate jolt to thaw the frozen veins of credit. February 17. Uncle Sam guarantees Northern Rock deposits like a shaky promise in a storm, but it's lipstick on a pig hemorrhaging cash. Then crash. Thunderclap loud. March 14. Bear Stearns, Wall Street's bullheaded survivor, roars its last breath. Bloated on MBS poison and leveraged to the hilt, it implodes in a weekend of white-knuckle negotiations. JP Morgan swoops in for a fire sale, $2 per share, down from $172 weeks earlier, with $30 billion Fed backstop. Too big to fail, ha. That's the myth torched in a bonfire of vanities, leaving traders shell-shocked and bonuses slashed. Christian Thwaites, CEO of Sentinel Investments in San Francisco, clenches his fists to hide the fear as bond prices crater to zero, no buyers, just echoes. Shell shock, he calls it, managing $28 billion while his team stares at screens bleeding red. On the streets, pure, unfiltered agony ripping through like shrapnel. Rates reset like venomous traps, millions of adjustable mortgages spike, squeezing families dry as a desert wind. Foreclosures explode 79% year-over-year, turning dream homes into ghost towns dotted with bank-owned signs like tombstones in a forgotten cemetery. Julia's world unravels. Clients vanish as the recession bites, her business craters from $270K to scraps. Then her husband bolts with their savings, leaving her with 2 kids, a part-time nursing gig, and a house payment like a noose. Neighborhood crime surges, robbed 5 times in a year, windows smashed, fear her constant shadow. "I felt like a loser," she confesses, juggling 3 jobs while her credit score plunges from pristine to 400, bankruptcy looming like a guillotine in 2011. The cracks aren't local, they're global fault lines. August 2007 sees central banks from the US to Japan pump billions in emergency liquidity, the first coordinated splash since 9/11. UBS in Switzerland, $3.4 billion subprime gut punch by October. In the Arab world, early tremors hit remittances from US-based workers, Egypt's lifeline drops, Gulf investments waver as oil prices flirt with peaks before the plunge. Karim Ullah, a UK-based Asian magazine publisher, launches his venture in June 2007, full of swagger, targeting big brands. Post-Lehman advertisers ghost him, he pours in family cash, but by 2008 it's over. Homeless, he hands over house keys, yanks his 11-year-old daughter from boarding school. Stress triggers his Crohn's to erupt, emergency surgery in an ambulance, his wife screaming as tubes snake in. We lost everything but each other, he says, rebuilding over 3 years with pop-up gigs forever scarred by the fragility. Investors claw at screens as red ink floods portfolios, global stocks tumble worse than post 9/11, the Dow peaking above 14,000 in October 2007 before its 50% nosedive. The ground's quaking harder now, can you feel the earth buckling? Summer 2008, IndyMac Bank detonates as one of the fattest U.S. failures, $32 billion in assets vaporized. Fannie and Freddie, the mortgage behemoths, teeter on seizure. The big ones barreling down brace for impact because September's about to unleash hell. September 2008, Hell's Gates swing wide, welcome to the bloodbath. The buildup, a pressure cooker of dread. May 6th, home values crater asterisk 15% asterisk from peak, panics a wildfire now licking at heels across suburbs and stock exchanges. July 11th, IndyMac detonates, branches boarded like plague houses, the largest U.S. bank bomb yet, $32 billion in ashes, depositors frozen in line like statues of despair. Joanna Entaukaki, just 13 in Athens, Greece, huddles with her family as TV blasts, sovereign debt spreads, and financial haircuts. The global spillover. A Greek tragedy in slow motion. By 2011, at 16, her nation's IMF EU bailout demands austerity knives, slashing dreams. She ditches environmental studies for economics abroad, fleeing at 18 to London, forever distrusting the system that stole her youth. September 7th, Titans Fannie Mae and Freddie Mac backing half America's homes with trillions in guarantees seized in a $200 billion government heist, the first major nationalization since the Great Depression. Lifelines or desperate defibrillators on a flatlining heart. The climax detonates on asterisk September 15th. Lehman Brothers falls hard. Fourth biggest on the street, this 158-year-old behemoth, $600 billion debt mountain crushing it flat, files for the largest bankruptcy in U.S. history. No bailout from Treasury Secretary Hank Paulson. Moral hazard be damned, we can't save everyone, he thunders, drawing a line in radioactive sand. Trading pits erupt in primal screams, brokers weep, phones shatter against walls. The Dow plunges 504 points asterisk, worse than Black Monday '87, while global markets convulse, erasing trillions in a digital inferno. Chiori's on the tube, Financial Times in hand. Lehman bankrupt, her stomach drops, managements were liquid, lies exposed. Back at the opulent office, her boss delivers the dagger. It's over. Colleagues raid the fridge for sweets with company cards, bathrooms uncleaned in the surreal limbo, migraines pounding like war drums. She transfers to Nomura, but the rot festers, unchanged greed in new suits, driving her to quit for Oxfam, rediscovering purpose in a $50K role that heals more than banking ever did. Credit, paralyzed in terror. Banks hoard cash like dragons guarding hoards, the interbank market a ghost town of whispers and shadows. The world's economy, teetering on the brink of asterisk total meltdown asterisk, with Lehman's tentacles, trades in 100 countries yanking everyone down. September 16th, AIG, the insurer of this casino nightmare with $2.7 trillion in assets, begs for mercy after a credit downgrade guts its CDS bets. Fed pumps in asterisk $85 billion asterisk, later ballooning to $182 billion to stop the domino apocalypse, but it's a bandage on a severed artery. September 19th, Paulson unveils TARP, the $700 billion troubled asset relief program to vacuum up toxic sludge with taxpayer billions. Public fury erupts. Bankers get bylaid. We get bills. September 25th, Washington Mutual, America's largest savings and loan, seized by FDIC, $307 billion in assets, the biggest bank failure ever, snapped up by J.P. Morgan. Wachovia follows to Wells Fargo. Goldman and Morgan Stanley, they morph into bank holding companies begging Fed protection. The old Wall Street, dead and buried. October 10th, the Dow's worst week ever asterisk, down 20%, 1,874 points evaporated as the U.S. sheds 240,000 jobs, unemployment clawing toward 10%. Central banks worldwide, U.S., EU, Britain, China slash rates in unison, a global SOS. But the shockwave, a tsunami. Europe plunges, Ireland's economy falls off a cliff, banks nationalized, Iceland's trio of lenders implode overnight, currency crashing 50%. Asia's export machine grinds silent, factories shutter in China, Japan as U.S. consumers ghost shopping malls. In the Arab world, the Gulf's oil boom sours fast. Dubai's real estate empire crumbles, $80 billion bailout from Abu Dhabi. Egypt's remittances from U.S. migrants plummet 20%, pushing 2 million toward poverty's edge. unemployment spiking to 12%. Leanne Liang in Oakland, California, a frugal immigrant's daughter, spots the carnage as opportunity, buys a $230K fixer-upper in 2009 with family loans, now worth over $1 million. Lucky timing, she shrugs, but warns of rollbacks eroding safeguards. November 25th, Fed unleashes quantitative easing key, buying $750 billion in MBS, $300 billion treasuries, printers roaring, balance sheet exploding to $4 trillion by 2014. December 19th, Bush's $17 billion auto lifeline to GM and Chrysler Ford dodges, but both file bankruptcy by June 2009, taxpayer loss $9 billion. Asterisk $22 million jobs obliterated globally. Asterisk 3.8 million U.S. homes foreclosed. Over 500 banks fail by 2015 versus 25 pre-crisis. Factories rust under gray skies, families fracture in tent cities, dreams deferred to a generation's dustbin. This wasn't a recession, it was economic. Asterisk World War III asterisk, a siege where the rich raided the vaults while the rest scavenged scraps. Who's left standing in the rubble, and can they rebuild without repeating the sins? June 2009, the official end. The recession troughs, markets bottom at Dow 6,500, but the ghosts, they haunt like fog over a battlefield. Unemployment claws at 10%, wealth gaps yawn like moon craters, a lost generation forged in foreclosures and food stamps, 8 million U.S. jobs gone, minorities hit hardest, black unemployment doubling to 16%. From the inferno rises a phoenix of reforms. February 2009, Obama's $787 billion stimulus juices infrastructure and tax cuts. April's G20 triples IMF funds for trade lifelines. May's bank stress tests force $75 billion capital raises. July 2010's Dodd-Frank Act, the 2,300-page behemoth, births the Consumer Financial Protection Bureau, slays proprietary trading via Volcker Rule, and arms regulators to dismantle too-big-to-fail Frankenbanks. TARP. Ends December 2014 with a $15 billion profit on $426 billion spent, but critics howl moral hazard. Banks fattened on bailouts while Main Street starved. Occupy Wall Street ignites September 2011. Zuccotti park a powder keg of pitchforks against the 1%, echoing Tea Party rage over TARP pork. Yet shadows linger. Dodd-Frank gutted in 2018 under Trump. CFPB neutered. Volcker diluted. Warnings of bubbles reborn in crypto or EVs. Nick Bailey, post-Lehman regulator, laments the golden era lost. 95% blame rich bankers, rightly so. Karim's family mends, but materialism's myth dies. Joanna builds in the UK, forever exiled from Greece's ruins. The brutal truth? Ambition unchecked is a monster, building empires on quicksand, devouring the innocent. But stability, that's the hero's quiet power, the shield against the storm's roar, etched in laws and lessons. Deregulation breeds dragons, vigilance slays them. Echoes scream today, crypto meltdowns, inflation beasts, bubble whispers in AI and green tech. Is asterisk the big one? Asterisk reloading its chambers? You tell me. Drop your hottest takes in the comments. 2008, overhyped apocalypse or blueprint for doom? Share your family's scars or windfalls. If this thrill ride left you breathless, asterisk crush asterisk like, subscribe to fuel more edge of your seat sagas and ring that bell next. The crisis that asterisk could swallow us whole. Thanks for riding the wave. Stay fierce, stay questioning, fade to black. Or is it just the calm before the next boom?